Bollinger Bands are a technical indicator that can be used to define trends and measure the volatility of financial instruments such as stocks. In this video, we'll go over how Bollinger Bands are calculated and applied, as well as the advantages and disadvantages of using this indicator. The bands are calculated using a moving average's standard deviation. A standard deviation is a statistic used in probability theory that is commonly used to measure volatility in financial markets. Standard deviation in financial markets measures the volatility of returns from a historical average or mean, such as a 20-day moving average. Typically, Bollinger Bands are drawn two standard deviations above and below a moving average. This means that the two bands are likely to contain 95% of a security's historical price movement. This data can help you contextualize trends and predict when they will become overextended and reverse. Because the bands typically contain about 95% of a security's price movement outside the bands is unusual but possible. When this happens, probability theory predicts that the security price will revert to a moving average or mean between the upper and lower bands. This is known as mean reversion, and some traders may use it to make trading decisions. Let's look at an example of how you might be able to use Bollinger Bands to identify entry and exit points. When the price of a security falls below the lower band, a potential entry point can be established. Before entering the trade, an investor might wait for the price to close back above the band. When using mean reversion strategies, this is a type of confirmation. When the security returns to its moving average, the reversion to the mean is complete. This is used as an exit strategy by some investors. Others may choose to exit at the upper band, which is typically a higher profit target and may take longer to achieve. Investors who use the upper band as a target may seek confirmation by allowing the price to move above the band and then waiting for a close back below the band before exiting a trade. The idea is that a break below the upper band will most likely result in a reversion to the moving average. Some investors seek further confirmation by examining the slope of the bands. Simply put, if the bands are sloping upward, the security is potentially in an uptrend. If the bands are sloping down, the security is potentially in a downtrend. As a result of referring to the slope, some investors may only consider entry points in uptrends and disregard entry points in downtrends. One of the primary advantages of using Bollinger Bands is the ability to time entry and exit points in these ways. Furthermore, the bands can assist investors in visualizing statistical properties of securities and identifying when prices move unexpectedly, two standard deviations away from a moving average. Keep in mind that these deviations can last for a long time, which is one of the most significant risks of using Bollinger Bands. Remember that probability theory assumes that security prices are mean reverting, but in practice, this assumption frequently fails. Here's an example of a security that has dropped to its lower band or two standard deviations below its moving average. Take note of how the price continues to fall along its lower band before returning to the moving average. The mean reversion can take a long time, and the price of a security may continue to fall during that time. As a result, when a security falls below the lower band, investors typically avoid taking entry points. It is dangerous to use Bollinger Bands as a standalone indicator. An investor may consider using Bollinger Bands to add context to trends and help time entry and exit points that arise from other forms of analysis, such as fundamentals and the market's overall trend for a more balanced approach.